This is Michael Ken, and this is our commentary for the week of September the 24th, 2012. So Europe and the U.S. central bankers pledged more bond buying. And Japan chimed in for an additional $100 billion of bond buying too. While, at the same time, over the course of the last 2 weeks, China pledged infrastructure building of another $150 billion. The Europeans and Americans used the terms unlimited and continuous in their announcements. The stock markets rejoiced, but the rally seems to have stalled after only 2 days following the Fed announcement of an additional $40 billion of monthly bond buying and a commitment to low interest rates through 2015. So why was the rally so short-lived? And do we expect it to resume? I believe 3 reasons explain why the rally was short-lived: expectations, fear, and uncertainty. Over the summer, expectations grew that further stimulus would be announced. It was, but there was little in terms of positive surprises or new solutions. So expectations were met but not exceeded, and the announcement was met by initial buying but then selling. Next, markets have looked at the newest stimulus measures and after first saying Yahoo, have reassessed and asked, is the economy so bad that we need all of this action and cheap credit? Further, some fear that these measures will create negative side effects, like a weakened dollar, further inflation in the future, and more government indebtedness, rather than spurring economic growth and employment. Fear is a powerful emotion for investors. Finally, uncertainty has quickly arisen again as markets question what geopolitical or economic issue is going to arrive next. Saber rattling in the Middle East, sovereign debt issues, weakening economic growth forecasts, and general unrest, often over austerity measures, are all issues giving rise to uncertainty and market volatility. As Canadian investors, 50% of our market is resources and energy, cyclical sectors that require global growth, sectors where a number of factors like price and demand are based on factors far beyond management's control. The IMF recently cut global GDP again, and both Caterpillar and FedEx reduced their earnings forecasts for next year. All signals that suggest there are challenges ahead. For us, our theme remains constant, as our concerns that headline risks remain high seems to be founded. We advocate income-paying assets from both dividends and interests, as sideways, sometimes volatile markets continue until investors feel more certain about the future. Our focus is on quality, and we continue to look for ways to hedge risk as markets strive for a sustainable rally based on positive global economic fundamentals, which appears to be beyond its current reach. That's it for this week. We thank you for listening and wish you and your family well.